In the 1600s, a group of merchants made a decision that would quietly change the global economy forever. Instead of funding risky overseas trade voyages themselves, they invited ordinary people to invest money in their ships. In return, those investors would receive a share of the profits. That simple idea created something revolutionary: the world's first stock market. Today, the stock market moves trillions of dollars every day and influences everything from retirement savings to global economies. But the real question is, what exactly is the stock market and how does it actually work? Let's break it down. The birth of public investment. Imagine a new company that wants to grow quickly. Maybe it produces coffee, builds technology, or manufactures electric cars. Expanding a business requires money, sometimes millions or even billions of dollars. Instead of borrowing huge loans, companies often raise money by selling small ownership pieces of their business. These pieces are called shares, and the process of selling them to the public is known as an initial public offering, or IPO. When a company goes public, anyone from large investment firms to everyday individuals can buy those shares. And once you buy a share, you become a partial owner of that company. Why investors buy stocks? Investors buy stocks for one main reason: they believe the company will grow. If a company becomes more successful, earning more revenue, expanding its business, and attracting more customers, more investors will want to buy its shares. And when more people want something limited, the price rises. That's exactly what happens in the stock market. As demand for a company's shares increases, the value of those shares goes up. For early investors, that increase means profit. But the market doesn't only go up. When confidence drops. If investors start believing that a company might struggle, maybe sales are falling, competition is rising, or the economy is weakening, they may rush to sell their shares. When many people sell and fewer people want to buy, the price drops. This constant balance between supply and demand is what causes stock prices to rise and fall every single day. And many different forces can influence those decisions. Changes in technology, shifts in leadership, global economic news, government policies, even public opinion. Sometimes a single headline can send stock prices soaring or crashing. The invisible force: human psychology. Despite all the charts and data, the stock market is not just numbers, it's also emotion. Fear can make investors sell too quickly. Excitement can push people to buy at high prices. And when millions of investors act on those emotions at the same time, markets can boom or collapse. Because of this unpredictability, many financial experts recommend a simple strategy: long-term investing. Instead of trying to predict every rise and fall, investors focus on steady growth over many years. The modern stock market. Today, thanks to the internet, the stock market is more accessible than ever. Anyone with a smartphone and a brokerage account can buy shares in some of the world's biggest companies. What once began in busy ports and coffee houses centuries ago has become a global financial system connecting millions of investors. And while the market may seem complex, its core idea remains surprisingly simple. Companies raise money to grow, investors share the risk, and if the business succeeds, everyone benefits. The first step to understanding this system is simply learning how it works.